You know that feeling, right? That sudden stomach-turning drop. The screen is just a sea of red. A stock market crash feels like this totally random, chaotic force of nature. But what if it's not? What if it actually follows a script?
So let's dive right into that. Because behind all the panic and the screaming headlines, there's actually a sequence of events. It's this incredible chain reaction of market mechanics and raw human psychology. In this explainer, we're going to pull back the curtain and really understand the anatomy of the disaster step by step.
Before you can really understand a heart attack, you need to know what a healthy heart looks like when it's just beating normally. So let's start there. Let's look at the market's normal, everyday pulse, this amazing system that most of the time just works. Okay, so this is our stage. A place like the National Stock Exchange, it's not just a building anymore. Think of it as this massive, sprawling digital ecosystem. It's where companies go to get the capital they need to grow and build cool stuff, and it's where millions of us can get a piece of that action. And man, it is a blur of activity every single second. You've got companies going public with IPOs, people trading everything from basic stocks to super complex derivatives, and just a constant river of data flowing through the system. It's all part of that healthy, high-speed pulse. But here's the thing about any complex system. It can be fragile. All it takes is one jolt from the outside, and a tiny crack can appear in the foundation. So the big question is, what causes that first crack? Well, honestly, it could be almost anything. A war could kick off somewhere, a central bank could suddenly decide to hike interest rates, maybe a regulator announces a surprise investigation into a huge company, or a key financial firm gets hacked. Now, none of these things on their own are enough to crash the market, but they all inject one really dangerous poison into the system: fear. And that fear, that's the spark that starts the whole chain reaction. So now, let's get into the nitty-gritty, the actual mechanics of how one little crack can turn into a full-blown, catastrophic downward spiral. All right, to get this, we have to talk about one super important idea: liquidity. Basically, when a market is healthy, there are always plenty of people who want to buy what you're selling, and vice versa. This balance is what lets you sell your shares without tanking the price. It's kind of like the market's built-in shock absorber. So check this out. This is what a healthy, liquid market looks like. See how the order book is all nice and balanced? For every person trying to sell at 99, there are plenty of buyers ready to go at 98. That gap is tiny, which keeps the price stable. It's orderly. But what happens when that initial shock hits? Fear starts to spread, and everybody tries to run for the door at the exact same time. This is the moment everything flips. And poof, just like that, the buyers disappear. I mean, look at the difference here. The buy side is practically empty while the sell side is absolutely flooded. So now if you want to sell, you've got to slash your price from 99 all the way down to 95 or even lower just to find anyone willing to buy. That shock absorber we were talking about? It just shattered. And this is where it gets really toxic, because it creates a horrible feedback loop. The very act of you trying to sell in a panic makes the price drop faster. That makes other people panic and sell, which drops the price even more. It's a concept called impact cost. You're basically pouring gasoline on the fire you're trying to escape. To stop this kind of nosedive, the system has a big red emergency button. If a stock or the whole market falls too far, too fast, the exchange itself hits the brakes. It's called a lower circuit, and it literally halts all trading. It's a last-ditch effort to force everyone to just take a breath and maybe, just maybe, break the panic spiral. So, we've seen the mechanics of the machine, but what's the ghost in that machine? What's the engine that's really driving this whole disaster? It's not computer code. It's us. It's all about human psychology. And you gotta remember, there are more of us, regular retail investors, in the market today than ever before. Technology has made it so easy for millions of people to get in on the action, and that's fantastic. But it also means that mass psychology, how we all feel and react together, plays a much, much bigger role now. Yeah, investor sentiment is a total double-edged sword. When confidence is high, it creates this awesome positive cycle. More people invest, markets go up, and everyone feels great. But when fear takes the wheel, oh boy, that whole thing slams into reverse and becomes a vicious downward spiral that leads to crashes and a total loss of trust. All right, so we've got the mechanics of the system and the psychology of the crowd. We see how they collide. But what does this all mean for you? For an individual trying to figure out what on earth to do when everything is going haywire? So, how do you ride out the storm? Well, first is knowledge. You have to understand that scammers and fraudsters love a good panic. Second, and this is the big one, is perspective. Remember that ups and downs are part of the game. Panicking and selling at the very bottom is a strategy, it's just usually the absolute worst one. The real play is to zoom out and focus on the long term reasons you invested in the first place. So, when you really break it all down, a market crash isn't just some random act of financial chaos. It's actually a pretty predictable story. It's the story of what happens when a cold, logical, mechanical system runs headfirst into the hot, irrational, and incredibly powerful force of human emotion. And that's our explainer. And it leaves us with one final thought. We spend so much time analyzing charts and companies and economic data. But what if the biggest risk we face in the market isn't out there at all? What if it's right here, in our own reaction to fear? Maybe mastering the market really starts with mastering ourselves.